So for those of you who joined in, obviously I did the stream yesterday. We spoke a little bit about gold. So we're going to continue on from that. Today we're going to obviously assess it from a footprint tool perspective. I'm going to show you kind of the nuance shift in and show you how the breakout trade works on the footprint tool, and hopefully you'll get a better understanding. So in terms of the structure of the stream, as per normal, we're going to go through a trade principle today. It's going to be that of a breakout, of a flag. Okay, so we're going to talk about a flag, the concept of a flag, etc., etc., and then we're going to talk about the trade opportunity, how you could have executed, risk management, etc., etc. Okay. So that's where we are at. We're going to look at two trades. One's a breakout trade and one is an auction imbalance trade. The one will be in the gold, which is the breakout trading, and the auction imbalance in the oil market. Okay, so straight into it then, and the best place to start is with this pretty little picture. Okay, so the textbooks, those the books that you obviously read when you start trading teaches you about these pennants or these flags or whatever you want to call it. What's important to understand when it comes to looking at chart patterns is not so much the observable pattern, but what elements create the observable pattern. Okay? So what do I mean by that? What I mean is that we can see that as the market found this low point, okay, call it what you want, 1470. As we found that low point, we can see on this hourly chart that there's very little two-way trade. Okay? In other words, we can see there's a very strong directional bias. Right? Market then continues to push higher, a little bit of consolidation, a little bit of two-way trade. Obviously the market runs into some liquidity here and then continues its ascent. Okay, so for all intents and purposes, we've got a relative straight line bid up. Okay, so a very strong buying impulse or initiative. Okay, so initiative taken from the buyers from 1470 all the way up to 1522, a nice $50 rally in the gold market. Okay. We then begin to see, and this is important, compare the types of red candles that we have in the submove. Okay, compare them to the types of red candles we now have at the top, and you'll see there's a significant difference. One, the volatility obviously has changed, but we can also see that the sellers are getting a little bit more sort of headway. In other words, by selling, they're obviously able to move price a little bit lower. Okay, now note that is likely to occur after an extended up move. Why? Because obviously the buyers are slightly less aggressive at these higher prices now than they were lower down. Okay, so that's what creates the pole of a flag. Okay, it's not just, oh, okay, you got the straight line and the sideways and then a continuation. Okay, it has to be initiative. It has to be a buying impulse, runs into liquidity, and ultimately we then eventually continue. Okay, now we can see for a number of days, we can see sellers entering. Okay, and notice how long it takes for sellers to get prices down. Okay, so this is almost 6-7 hours of trade, right? But prices managed to get back down to 10. So a good $12 move to the downside, but it takes them 6 hours. Okay? Then in the space of, call it 4 hours, okay, prices are all the way back up. Okay, and then we continue to grind down low for almost a good another entire day, day and a half. And then in 2 hours, prices are back up. Okay, and then for another 2.5 days, 3 days, okay, we can get prices down, but then in 2 hours, prices are straight back up. Right? That's price action, guys. In other words, the sellers have to exert a lot of effort, a lot of energy to get prices lower, right? Whereas the buyers, ultimately, once they buy, there's very little offer in place. Okay, and that's very, very key to a flag. It's very important to understand. So we have initiative followed by two-way trade. Again, it's not necessarily always downward sloping. You can get upward sloping. You can get sideways sloping. Okay, the important aspect is that the sellers take a lot of effort to get prices low, whereas the buyers are quite easily getting prices up. Okay, and that should make sense. Why? Because if this is a flag, if this is truly a strong trend, ultimately the buyers should be fully in control. And all we're seeing here is a bout of two-way trade or accumulation phase. All right, eventually we get the break. Okay, so we break up above a certain price point, which happens to be whatever that price is. We see a reaction. In other words, we can see a shift in the dynamic of the market. We can see that with the volume, but also the range of prices over which we trade. And ultimately, prices then begin to initiate again. Note what I said, not two-way trade, initiate. So notice, bid, little shallow pullback, bid, shallow pullback, bid, shallow pullback. Okay, so it's very, very important that the continuation looks very similar to the beginning. In other words, we have initiative, buyers and controls, liquidity met, liquidity found, a lot of two-way trade, and then a continuation. That forms a flag. Not the picture, not these textbook pictures, but the initiative followed by two-way trade followed by continued initiative. Okay, that's the basic proponents of a flag. Now, what we're going to look at today is we're going to dive into this section here. So we know the flag exists, and this is the thing, you can't preempt a flag, and this is why, for all intents and purposes, I hate flags, because they're very much a Harry hindsight. Obviously, you'll get people post a picture saying, oh yeah, no, you just have to buy it there, and buy more there, and it just keeps going up. Okay, but it's not always that straightforward. As a day trader, we're not about guessing. We're not about this is a flag and it's going to continue. What we're about is we're about assessing, which is we know this potential flag exists. Okay, and what we need to see is we need to see something that gives us the trigger in this point. Okay, why do I say that? Think about the risk dynamics. If you preempt and you buy here, assuming maybe we have a flag, okay, you have very little information and you have unlimited risk. Okay, the same goes to say yeah, the same goes to say yeah. Okay, the more preempting that you do, the less information you have, the more risk you take. Okay, so yes, you can argue that at this point it was a very established flag and you could buy it here and you could make lots of money, but it's all about that information spectrum. Okay, equally it's about the risk reward and the speed of risk reward. Right? If you sat for 3, 4, 5 days inside this flag, okay, you took on a lot of risk with very unknown reward. Right? The longer you waited for the market to give you the timing on that break, right, you're going to get more reward, okay, in terms of the risk you're taking. In other words, if you're entering down, yeah, you're taking unknown risk. If you enter up, yeah, you're taking exact risk. Okay, when you take exact risk, you're getting much better bang for your buck. And that's what breakout trading is all about. It's about that timing so that you get in on the break with limited risk and ultimately you get to partake in the next leg of initiative. Okay. Important you have to think about that, guys. It's a very deep concept, but it's going to sort of almost shift your thinking that the opportunity isn't necessarily always early. Sometimes the opportunity is late. Okay, there are strategies, and a lot of the strategies focus on the stream. There are strategies where it's more valuable to be early. In other words, it's more valuable to preempt. Why? Because the risk reward makes sense to preempt. In this instance, there's no additional value of preempting. Wait for the market to give you the clue and then enter. And that's the clue we're going to discuss. So what you're looking at in front of you is a 5-minute footprint chart. Now, we talk a lot about axis candles. If you've done the footprint course, you'll know all about axis candles. Okay? An axis candle is a timing candle. It's a candle that says, now's your time. Now's the time to get in. Okay? And this was it. It was around about the 17.3. It came at 7:25 p.m. on the 12th of August. Okay. Now, how do we know it's an axis candle? I'll give you a brief overview. Right. One, it's the shift in dynamic of the market. So if you look and you compare, we did 2,000 volume. Okay, so 2,000 contracts traded ahead of that break point. Okay, now that break point comes in somewhere around the 21 to 22 area. Okay. So we're preempting the break now, but we're not preempting as in, okay, we think it's a buy now. We're preempting based on the change in the market dynamic, and that's what the axis is. It's the change. Okay, so we can see the highest traded volume prior to that was at 5:30 in the afternoon. Okay, and all of a sudden, over a space of 2 hours, nothing's going on. Suddenly, someone buys 2,000 contracts, and more importantly, someone starts lifting offers quite aggressively. And we can see that, yeah, 300 lot offers got lifted. Okay, the market came back down the next 5-minute rotation, and we see some absorption. Okay, so we can see another 600 contracts traded over 4 prices, and that's the absorption. That's the reload from the buyers coming in. Market then starts to go bid, and note what the buyers are doing. They're no longer waiting now, no longer passive. They're lifting pretty heavy offers. Okay, another 1,000 contracts lifted over 4 prices at market. Okay, so the buyers have shifted from being passive to now being aggressive. Not only absorbing, but they're also lifting as much as they can at the best offered price. Okay, and suddenly the market blips. Okay, 16,000 contracts trade, stops are triggered, and that's the break of the flag. Okay, so that's the beginning now. That's the impulse. That's the stops. Right, nice 130, 140 tick move, and then the market navigates, rotates, come back lower, and we come and retest that break point around the 1518s. Okay, gets bought back up, and the market just settles down for the rest of the night. Now, what's important to do is to go into the Asian session. So Asia opens up at 11 o'clock, or does nothing for the first bit, and all of a sudden a little bit of risk off comes in, and notice the volume shift from 200, averaging 200 contracts every 5 minutes, to suddenly 2,500. That's tenfold volume, guys. Okay, that's the impulse move. Suddenly the buyers step it up and step into the market quite aggressively. Okay, that is a substantial amount. 14,000 contracts at 2 a.m. in the morning is substantial. Okay, it's big time frame participants in the Asian session. Okay, so this is the beginning of our move now, 1520s. That's where that initiative was taken at the start of the Asian session. We've held on to those 18.8, which was the retest of the flag break. Okay, so we retested the flag break, and we started to initiate. Okay, market initiated initially once. We then came, and at the 6:30 a.m. again, we saw a second bout of initiative. Okay, and then a third bout of initiative. So the market's just briefly grinding higher and higher and higher. Note we obviously tested 15.17, and as of currently we're trading around 15.37, so we're a good $20 higher. Okay, now what I would say, it's extremely unusual, okay, to see overnight initiative untested. In other words, yes, this is a strong initiative move to the upside. Okay, but don't be surprised to see the market come back and at least test 15.27 and 15.20. Okay, so keep an eye on that over the course of the day. The next part of the stream, we're going to talk about the technical aspect, and this is important to understand. This is where I'm going to kind of highlight. It's one thing knowing about a flag. It's one thing sort of looking and saying there's a flag in the market. Okay, but the most important thing is to be aware now that there are a lot of long positions, very aggressively positioned. In other words, this 1520 to 1522 is crucial. Okay, if we take that out, right, the market is not only going to very quickly re-enter this flag, but it's equally going to take out a lot of stops to the downside, i.e. a lot of profit taking will be initiated. Okay, not a turn of the trend, not a time to suddenly turn short gold for any other reason. The trend is firmly to the upside, but in the event, okay, in the small probabilistic event that we get back below that 1520 area and we start to sustain prices, the moment we trigger prices below 1517, right, you've got very good downside risk reward back towards the base of that flag. Okay, and that's what we mean by technicals. Right now, you want to keep buying this market. Nothing signals a short. Nothing signals anything other than prices are going to grind higher, right? Until such a point we get back below that 1517, we stay long, look for a continuation of this flag to the upside. Okay, but do be aware, overnight initiative, which we've seen from 2 a.m. Okay, it's likely to be tested. Don't be surprised to see this market come back, test around that 1520, really see if the buyers want to hold on to those positions or not. Okay, and that's the flag definition, guys. Now, where I want to kind of just go to in terms of the stream is I just want to finish off and talk a little bit about the oil market, because structurally it's showing us something very, very interesting.